Central banks around the world have purchased more physical gold in the past 18 months than at any point since 1967, while retail investors flood into the market chasing a rally that institutional traders have been quietly building for years. The Federal Reserve is signaling a policy shift that could reshape the entire precious metals landscape. And somewhere between the headlines about safe haven demand and the whispered warnings about bull traps, a question is forming that most financial commentators refuse to ask directly. Is this the beginning of a generational wealth transfer into gold, or are late buyers walking straight into the most dangerous trade of the decade? Here's what they are not telling you. Gold has surged past $5,000 per ounce. The financial media calls it a safe haven rally. The surface narrative is simple: geopolitical tensions, inflation fears, rate cut expectations. But beneath that surface, something more complex is happening. Something that separates the investors who understand what comes next from those who will become exit liquidity for smarter money. The question is not whether gold is rising. The question is whether you are early or whether you are already too late. Welcome to Metals Crux. Now, before we continue, if you have been watching markets long enough to remember when gold was dismissed as a barbarous relic, when financial advisors told clients that precious metals had no place in a modern portfolio, then you understand something that newer investors often miss. You understand that consensus opinion is frequently wrong at exactly the moment it matters most. Do me a favor. The same way you might share critical intelligence with someone whose financial future you genuinely care about, take a moment and subscribe to this channel. Not because an algorithm suggested it, not because a notification appeared on your screen, but because the analysis we conduct here requires patience, context, and a willingness to examine what others prefer to ignore. And while you are here, drop a comment below. Tell us where in the world you're watching from. New York, London, Singapore, Dubai, Zurich. Because what is unfolding in gold markets right now does not respect borders, time zones, or traditional financial boundaries. And neither should the people trying to understand it. Now, let us examine what is actually happening beneath the surface. The most important driver of gold in this cycle is not inflation itself. It is real interest rates and the evolving Federal Reserve narrative. This distinction matters more than most commentary acknowledges. Central bankers are signaling a cautious shift from aggressive monetary tightening toward a more neutral stance. Some analysts believe easing is already being priced into forward curves. Markets are increasingly positioning for a world where inflation does not vanish but simply cools, where policy rates stop climbing and potentially edge lower, where real yields become less attractive compared to hard assets that carry no counterparty risk. When real yields soften, the opportunity cost of holding gold decreases. Money sitting in bonds earns less. Money sitting in gold loses nothing by comparison. That is exactly the environment where institutional allocators begin repositioning. That is exactly the environment where long-term accumulation accelerates. But here is what experienced observers understand that newer market participants often miss. This same environment creates dangerous conditions for late buyers. The smart money has been accumulating for months, in some cases years, before the rally became obvious. They bought when gold was ignored. They positioned themselves when financial media was focused elsewhere. Now, as retail investors chase the move as fear of missing out replaces fear of loss, those same institutions have the opportunity to distribute their positions into strength. This is how markets have always functioned. How the early money builds positions quietly, the late money provides liquidity for exits. The question every investor must ask themselves is brutally simple. Which side of that trade are you on? The current rally is not emerging from a vacuum. It is the product of several macro forces colliding simultaneously. Economic data across major economies is mixed. There are pockets of resilience on the surface, but underneath the headline numbers, the picture is more concerning. Slowing manufacturing activity, cautious consumer behavior, fragile corporate margins, rising credit stress in sectors that expanded aggressively during the zero-rate era. This is classic late-cycle behavior. This is the environment that precedes recessions, not the environment that signals all clear. Investors hate uncertainty more than they hate bad news. As talk of potential slowdown circulates through trading desks and investment committees, portfolio managers rotate capital toward assets that perform differently than equities. Central banks themselves have become structural buyers. Several emerging market central banks have been steadily adding gold to their reserves, reducing their dependence on dollar-denominated assets, diversifying away from single currency risk in ways that carry profound long-term implications. The ongoing discussion around BRICS nations and alternative settlement systems keeps a persistent narrative alive. The global monetary order is shifting, not collapsing overnight, not disappearing entirely, but evolving in ways that favor assets with no counterparty risk, no political allegiance, no dependence on any single government's credibility. Gold is the only major financial asset that exists outside the traditional credit system. It is the only asset that cannot be printed, sanctioned, frozen, or defaulted upon. Central banks understand this. They have understood it for centuries, and their actions speak louder than any commentary. This structural bid from the official sector creates a floor beneath gold prices even when speculative flows turn volatile. It provides support that did not exist in previous cycles. It changes the risk-reward calculation for long-term holders. But floors do not prevent corrections. Structural demand does not eliminate volatility, and safe havens can behave like wild animals when fear and greed collide. The geopolitical backdrop is anything but calm. Regional conflicts, great power tensions, trade disputes conducted through tariffs and technology restrictions, energy market disruptions, currency interventions. The headlines change daily, but the underlying reality remains constant. The world is not stable. The post-Cold War order that defined the previous 3 decades is fragmenting, and in that fragmentation, capital seeks shelter. Gold catches safe haven, flows whenever uncertainty spikes, but it also attracts speculative money-chasing momentum. Distinguishing between the two is essential for understanding what happens next. The United States dollar adds another layer of complexity. Gold typically moves inversely to dollar strength. Recently, the dollar has looked more hesitant, responding to softer economic data and evolving rate expectations. The absence of a relentless dollar surge gives gold breathing room. If markets continue pricing slower growth and a less aggressive Federal Reserve, dollar strength could fade further, providing additional tailwind for precious metals. But currencies do not move in straight lines. Policy surprises happen, economic data shifts, and traders who position for one outcome often find themselves caught when reality diverges from expectation. Here is the uncomfortable truth that most gold commentary avoids. This is not a one-way trade. Bulls have the narrative wind at their backs. Central bank buying provides structural support. Safe haven demand is real and growing. The macro environment favors hard assets over paper promises. But bears are patient. They are waiting for any policy surprise, any economic data point, any shift in Federal Reserve communication that could trigger a reversal. They understand that the most painful moves happen when consensus is strongest. They know that late buyers, the ones who entered after the rally became obvious, are the most vulnerable to sharp corrections. The same volatility that creates opportunity for early movers creates destruction for late arrivals. The same forces that drive prices higher can reverse with equal intensity. Gold is not dead. The safe haven trade is not over. Precious metals remain at the center of the global risk debate. But respecting this market means acknowledging its complexity. It means sizing positions appropriately. It means understanding that even assets which preserve wealth over decades can inflict significant pain over months. Whether this move becomes a full breakout toward $6,000 or reveals itself as a brutal bull trap depends on variables that have not yet been resolved. Real rates, Federal Reserve policy, global growth trajectories, dollar dynamics, geopolitical developments that cannot be predicted. The institutions have positioned themselves. The central banks have accumulated. The question is whether individual investors understand the game they are entering, or whether they are simply providing liquidity for those who arrived first. In markets, timing is not everything. But it is not nothing either. And in a trade where the difference between early and late can mean the difference between building wealth and becoming exit liquidity, understanding where you stand is not optional. It is essential. The signal is forming. The question is what you do with it.